1. Introduction. Audit evidence, foundation of audit opinion. Auditor's conclusion is based only on the evidence collected during the audit. Without proper evidence, audit opinion has no credibility. Audit evidence is covered under SA 500 issued by ICAI. Audit evidence comprises all information, whether internal or external, written or oral, documentary or physical, which assists the auditor in forming an opinion. The quality, quantity, sufficiency, and appropriateness of evidence directly impact the level of assurance auditor can provide. The reliability of audit report. Namzar 2. Meaning of audit evidence, SA 500. Definition. Audit evidence is all the information used by the auditor in arriving at the conclusions on which the auditor's opinion is based. It includes information contained in the accounting records underlying the financial statements and other information. Characteristics. 1. Covers all information, not limited to books of account. Includes documents, management representations, confirmations, physical observations, analytical procedures. 2. Source of audit evidence, accounting records, ledgers, trial balance, journals, other information, confirmations from debtors, reports from management's experts. 3. Form of evidence, physical form, inventory count, documentary form, invoices, contracts, confirmations, oral form, management explanations, electronic form, EDP records, system reports. 4. Role of audit evidence, provides basis for auditor to form opinion, reduces audit risk by supporting conclusions, ensures financial statements are free from material misstatement. Number 3. Types of audit evidence. Audit evidence can be classified in two broad ways. A. Based on nature of evidence. 1. Physical evidence, obtained by direct inspection observation. Examples: physical verification of inventory, counting cash in hand, inspecting tangible fixed assets. Strongest form of evidence because auditor sees it directly. 2. Documentary evidence, based on documents generated either internally or externally. Examples: sales invoices, purchase bills, contracts and agreements, bank passbook and statements. Reliability, external documents, internal documents. 3. Oral evidence, obtained from inquiries, discussions, representations made by management or staff. Examples: explanations regarding unusual transactions, clarifications about accounting policies. Least reliable unless supported by other evidence. 4. Analytical evidence, obtained by analyzing and comparing relationships among data. Examples: ratio analysis, gross profit ratio, current ratio. Trend analysis, year-on-year sales growth, useful for detecting unusual fluctuations. B. Based on source of evidence. 1. Internal evidence, generated inside the entity. Example: copies of invoices prepared by company, internal reports. Reliability depends on strength of internal control. 2. External evidence, obtained from independent third parties. Examples: bank confirmations, supplier confirmations, more reliable since independent of management influence. 3. Mixed evidence, both internal and external. Example: supplier invoice received externally, but approved internally by purchase department. Reliability lies between internal and external. Relevance and reliability of audit evidence. A. Relevance. Audit evidence is relevant if it relates to the audit objective being tested. Example: to test existence of assets, physical verification is relevant. To test valuation of assets, external market prices are relevant. B. Reliability. Depends on nature, source, and circumstances. 1. External evidence, internal evidence. 2. Evidence obtained directly by auditor, evidence obtained indirectly. 3. Written documents, oral explanations. 4. Original documents, photocopies. Guiding principle. Auditor must evaluate both relevance, does it relate to the assertion, and reliability, can it be trusted? Knob 5. Sufficient, appropriate audit evidence. Sufficiency equals quantity of evidence. Higher the risk of misstatement, more evidence required. Low quality evidence requires more quantity. Appropriateness equals quality of evidence, measured in terms of relevance and reliability. High quality evidence reduces need for volume. Balance between sufficiency and appropriateness. Auditor must judge whether evidence is sufficient, enough in number, and appropriate, valid, reliable. Example: 1 strong confirmation from bank, several weak oral explanations. Number 6. Sources of audit evidence. Audit evidence can be drawn from 1. Accounting records, journals, ledgers, trial balances. 2. Supporting documents, invoices, receipts, contracts. 3. Physical examination, inventory, fixed assets. 4. External confirmations, banks, debtors, creditors. 5. Analytical procedures, ratios, trend analysis. 6. Management inquiries, discussions, clarifications. Chapter 7. Audit procedures for obtaining audit evidence. Auditor uses a combination of procedures. 1. Inspection, examining records, documents, or tangible assets. Example, checking contracts for terms, inspecting machinery. 2. Observation, watching a process procedure performed. Example, observing staff counting inventory. 3. Inquiry, seeking information from management or staff. Example, asking reasons for increase in expenses. 4. Confirmation, obtaining written response from third party. Example, confirming debtor balance. 5. Recalculation, checking mathematical accuracy. Example, recalculating depreciation. 6. Reperformance, auditor independently performs procedures already done by entity. Example, reperforming bank reconciliation. 7. Analytical procedures, studying data relationships and patterns. Example, comparing ratios, seasonal sales trends. 8. Assertions in financial statements. Audit evidence is gathered to test assertions made by management. A. Assertions about transactions and events. Occurrence, transactions recorded actually happened. Completeness, all transactions recorded. Accuracy, amounts are correct. Cutoff, recorded in correct accounting period. Classification, properly classified. B. Assertions about account balances. Existence, assets, liabilities exist. Rights and obligations, entity owns rights to assets and owes obligations. Completeness, all balances included. Valuation and allocation, properly valued and allocated. C. Assertions about presentation and disclosure. Occurrence and rights obligations, disclosed events assets belong to entity. Completeness, all disclosures made. Classification and understandability, clear presentation. Accuracy and valuation, disclosures are correct. Nash 9. Audit trail. Audit trails path of data through accounting records back to source. Auditor follows trail to confirm. Completeness, accuracy, existence of transactions. Example, from balance sheet inventory figure, stock ledger, goods receipt note, purchase invoice, supplier. 10. Information to be used as audit evidence. A. Using work of management's expert. Example, actuary for pension liability, valuer for property. Auditor evaluates, competence, independence, assumptions used, adequacy of work. B. Information produced by entity. Example, system-generated reports. Auditor evaluates whether such information is reliable before use. Number 11. Selecting items for testing. Auditor chooses items for testing through 1. Selecting all items, where population is small or risk is high. 2. Selecting specific items. Auditor targets important or unusual transactions. 3. Audit sampling. Uses statistical or non-statistical sampling. Ensures efficiency while covering population. 12. Inconsistencies in audit evidence. If conflicting evidence is obtained, auditor must investigate, obtain additional corroborating evidence, resolve doubts before concluding. Number 13. Using work of management's expert steps auditor must take. Assess expert's skills and competence. Ensure expert is independent. Evaluate methods and assumptions used. Decide whether expert's work is sufficient for audit opinion. Evaluation of audit evidence. At final stage, auditor evaluates 1. Whether sufficient and appropriate evidence collected. 2. Whether evidence is consistent and supports financial statements. 3. Whether evidence reveals any material misstatements. If evidence is inadequate, auditor must modify report or refuse to issue an opinion. Disclaimer. This is the super detailed master note